Okay, welcome everybody. Let's talk about universal life policies. Now, I love a good universal life policy because the great thing about a universal life policy is the premium flexibility of it all. Because remember, in the level term policy, we talked about how the death benefit has to stay the same and the premium stays the same for that term. And then in whole life, the premium stays the same and the death benefit stays the same as well. And so there is no changing the premium and there is no changing the death benefit. But one of the great things that you have with the universal life policy is that you can change those things, that it is very, very flexible. Also, it does build cash value like a whole life policy does. And neither the increase or decrease in the death benefit requires the issue of a new policy. Now, typically, it's a lot harder to increase the death benefit. You usually have to answer some underwriting questions. But as far as decreasing the death benefit, I have lots of clients that will call me up and, they'll say, hey, I don't really need this much death benefit anymore. Is there any way that we could, I've got enough of my savings or my kids are out on their own. Is there any way we can decrease this death benefit? And we can do that. Whereas with a whole life and a term policy, it's very hard to do that. Now, interest is credited monthly on the cash value. You always know what your charges are for mortality expenses and everything because they are deducted monthly. And it can function like a term policy or a whole life policy. Now, I'm going to show you how that works. But first, I made this diagram for you to kind of show you how a universal life policy works. So think of this as a bucket here, and you have this cash that goes into the policy, and this is your premium, of course. And then the cash comes out. Some of the cash comes out for mortality charges. Some of the cash comes out for expenses. And then whatever remains in there after mortality and expenses are removed, this is your cash value. And this cash value earns interest. Okay. And then of course, you have your death benefit as well. Now, when I say that it can be a term policy, it can operate as a term policy or, a permanent policy. What I mean by that is if you put the minimum premium in there, then it will not build cash value. So going back over here to this screen, if you put the minimum premium in this particular policy, okay, then there won't be any cash value left. It will either the monies will go to mortality charges and to policy expenses. So that's where it can operate like a term policy. So it can fit your needs throughout your life. Whereas remember, your term policy and your whole life policies, the death benefit stays the same, the premium stays the same. Or once you hit the target premium and you start paying a little bit more, now you're building cash value. Now, one of the things you need to know for your state test as well is the target premium is what they use to also decide what the agent will get as a insurance commission. Now, since the government doesn't want you to put all this money into a life policy, because what happens if that insured dies, the beneficiary gets the money's tax-free, right? So there is a maximum premium. There is so much premium that you can put in this universal life policy. But remember a couple of things. Universal life policy is very flexible. Payments can be skipped, they can be increased, they can be decreased. So it definitely fits the life stages. The life goals at the stages that you're going to. Again, there's a minimum and a maximum premium, and there is that corridor of insurance where the government says, hey, this is the maximum you can put into this policy. Keep in mind also that death benefit can be increased or decreased. So you have that target premium and, you can decide, hey, I don't necessarily want this to last to age 100, like a whole life policy. Maybe I want it to last to age 82, so again, very, very flexible with that. Now, there is a death benefit option, okay? So this is option A or option 1, and this is very similar to how a whole life works. Remember, the cash value grows inside the policy. If an insured dies, you don't get the death benefit and the cash value, okay? And this is, if you pick this option, that is the same way that a whole life policy works. The death benefit goes into the cash value. The cash value actually goes into that death benefit. They are not separate. Now, if you want a separate cash value, then you would pick option B or option 2. And this is where the beneficiary will not only get the death benefit, but also the cash value as well. Okay. Okay. So if you want some more great information like this in a lot more detail, if you're studying for your state law tests, it doesn't matter what state you're in, you can go to this website here, tdinsuranceexamprep.com. For $97, you can have the most tested information that is on the state test that you will have. So this is a great supplement to your state exam. It's for $97 and you get 110 days access to videos, some great in-depth videos, PDF worksheets, and some cheat sheets. All right. Thank you so much. I'll see you in the next video.